it's hard to time the market, but if you look at things from a very simple perspective, and that's how I like to break everything down, stocks trade on two things. How much money do they make, and what multiple do you assign to it? And if we assign a multiple less than 30, we're going to be sellers when it's up over 30, and we'll be buyers when it's 24, 25. Now, in this case, you never know, because there's always people that are there to buy Apple, whether it's an index fund or Apple themselves or Berkshire. There's a lot of action around Apple. It's a very, very popular traded stock. And to us, it doesn't matter if it's defined as growth or value. We invest in companies that pay dividends and grow dividends. Some of them are certainly going to be value stocks just for the nature of the dividend. And many of the big eight, because they don't pay dividends, aren't candidates for us. But ours is a strategy of total return, conservative portfolios for the long term. They're going to have a tremendous hedge against inflation, regardless of what markets do, because of that rising dividend. The strategy over the past 10 years, 11 years, we shoot for a 10% CAGR. We want to see the compounding annual growth rate of the dividend increase at 10%. That's a lot. I mean, that's a pretty big raise. If inflation's at 9%, well, at least we're fighting it. If inflation's back down to 3%, that's a darn good hedge against inflation.